So thank you. We're gonna keep with this very. Okay, I'm gonna wait for you guys to. We're gonna keep with this interesting subject, which is innovation and competition, and what should we do about it. And we are going to have an interesting panel, and it's a very challenging also panel because we have a lot to say with very interesting people to speak, but we're gonna have to do in 10 minutes each, and we're gonna make it good. So I'm gonna skip the introduction because everybody here is very known, and so I won't be the ones to go ahead with the short bios and whatever, because we do need time to go further. So let's go in with the order of the program, and Professor Shelanski will join us after all during the questions and last comments. And I think that's a good it's a good start to start with Professor Marcos Lyra, which is going to give us, he is a professor of UFI and also a member of the GDEC. And he's going to give us a presentation about competition and innovation, looking into merger innovation effect, right?
Thank you, Camila. I'm just waiting for Guilherme to prepare my slides. I have very quick slides, which I think I'm going to stand because it's easier to look at the slides. Is it okay? Okay, problem solved. So don't stop my time yet. Now you can. So thank you all for being here. I'm not going to thank anyone for being invited because I'm one of the organizers. But it's a pleasure to be here. I'm very honored to be able to speak about innovation competition, which is the subject I've been studying for many years now. And I'm going to specifically talk to you today about merger control, innovation in merger control. So to begin with, assessing innovation competitions is still a challenge. We know that there are many proposals out there. Jurisdictions have done a lot of different attempts, but in reality, it is inconsistent. We have many papers that show that decisions on different jurisdictions don't follow a similar procedure and they differ between each other. And the reason is due to the fact that innovation competition is a complex and heterogeneous process as innovation itself is. There's not a single type of innovation. It's a very complex process and also obviously complex to assess cases in which we have a lot of innovation. So the assessment needs to consider firm specificities, sector specificities. It's very hard to do that. And there's innovation competition when there is a product market and firms innovate to surpass their rivals. There is innovation competition when pipelines race to get a patent in the market. And there is innovation competition when firms have similar lines of research, similar capabilities. So all of this is innovation competition. It's not just products which are competing to prices and quantities, etc., etc. So the standard analysis that we use in merger control, designed for price effects, are not enough. There may be enough in some cases, but they're definitely not able to consider all types of innovation competition. So a first problem is that relevant market definition cannot be product-centered, because if we have two firms which have a pipeline project which haven't got to the market yet, we have innovation competition and we don't have a product market. So also structural variables, they say basically nothing about innovation, because we may have some sectors in which there is a lot of concentration and a lot of innovation, and sectors in which we have very low concentration and a lot of innovation. So the Schumpeterian hypothesis, they say nothing here. So also There are not enough tools to assess innovation competition, so it's also a problem. And there's actually the danger of under-enforcement. If you don't have the proper tools, if you don't know how to analyze this process, we may have the danger of under-enforcing. So a possibility which is on some part of literature, which I like it very much, is using a capabilities-based assessment. Basically, we can define a relevant market by the presence of innovation capabilities. So firms which are competing in innovation are not only the firms who have products or that have pipelines. If firms have capabilities to enter the market, they are exerting competitive pressure. They are potential rivals. They need to be considered. Also, the competitive significance of those firms are the extent of those capabilities. So we can use that, and actually, there is a way to do that. We can use a lot of different literature from the conventional one. We can use the resource-based approach, following Edith Penrose, which defines firms as sets of resources, and such resources represent their competitive potential, and a lot of other literature that follow Penrose's work, like strategic management, the evolutionary theory, etc. And we can also assess unilateral innovation effects using an approach like that. Because similar to when we have differentiated products, the closer pipelines are, the closer capabilities are, the closer lines of research are, the greater harm to innovation is if we have a merger. So we have ways to do that. And we can do that by considering the two channels of harm to innovation by Kokoris and Valetti. There is harm to innovation when a merger may generate the delay or interruption of a specific innovation effort, as we've seen in a lot of pipeline competition cases, and also when there is a potential reduction in innovation efforts in the future due to less innovation incentives. So there was actually a step forward in this direction when we consider the four-layer competitive assessment adopted by the European Commission in 2017. It is a step forward because it simultaneously considers price and innovation competition. The last two layers of competition which are assessed are actually innovation, both innovations regarding pipelines and between firms with similar lines of research. It is a step forward, but not enough. Why isn't that enough? Because the cases which were assessed, are basically Dow DuPont, Bayer Monsanto, and AbbVie Allergan, they are cases in which innovation is well defined in step-by-step procedures. So analyzing the effects on markets is easier because we have patents, we have patent citation, everything is easy. But when we have firms which we don't have ways to measure those capabilities, we need to look into other literature. So we need to use new tools and to assess other sectors. Well, a little bit about Brazil. If we say that Brazil and CADE don't look at innovation competition, it is a lie. We do look. Maybe we don't look enough, but we do to some extent. Because if you look from 2015 to 2022, 16.5% of cases had some discussion of innovation, considering only the cases that went to the tribunal. So we had some discussion. In some cases, the commissioners started this discussion. In some cases, it was the superintendent general. In some cases, it was one of the parties, and the tribunal had to discuss that. We have even had a case in which the Department of Economic Studies that brought innovation to the discussion. But we only have one case in which we have an innovation market defined, which was Bayer Monsanto. The relevant market was defined by considering research and development, etc., etc. That is actually good news, because not only they had an innovation market definition, but it had plenty of discussion of innovation regarding, as an example, unilateral innovation effects, and innovation was part of the discussion all along. And IE-UFRJ is actually very interesting. We were discussing IE-UFRJ earlier today. It is a case in which we have some discussion of innovation, but the report by the General Superintendent said that, well, we need to discuss innovation. We're doing as good as we can, but we don't have enough tools. It is sad that, and it was true, because back then it was at the same time that the Europeans were discussing Dow DuPont, in which they were developing new tools. So, but it's good news, because CADE says that we need to and we can look at innovation more properly. So some final remarks. assessing innovation competition needs to consider firms' idiosyncrasies, heterogeneity of innovation. The standard analysis will not suffice in many cases, in order it will. Cases in which innovation does not follow well-defined pipeline stages are harder to assess. But we can look at contributions from the strategic management literature, from the evolutionary theory, and there are also some challenges ahead, because I believe we have gone pretty far. I mean, we have a lot to go, but we have covered some ground. But we are discussing digital platforms. I know this is not this panel is not about digital platforms, but everyone will talk about digital platforms at some extent, because everyone just talks about that. But these digital markets are highly innovative. And if we wanted to take care of those cases, if we go to ex-ante regulations and we impose obligations, how can we impose obligations if we don't understand innovation competition, how innovation works on these platforms? We need to do that, because if we do that, we're going to use better remedies, and it's going to be a much, much better enforcement. Actually, Professor Shelanski gave a nice lecture on that. His paper is very on this direction of addressing the precise remedies that need to consider the specificities of each case, of each type of innovation competition, and I think that's the right direction, but we have still a lot to cover, especially here in Brazil. Thank you.
Very good. Thank you very much, Professor Marcos. And so you were speaking about capabilities, about the necessity of going into sector-specific approaches and specifics of innovation process. And we are not going to talk about digital right now, or at least not only about digital, because we are gonna to go further, move to the financial and payment sectors. So first, Renato, which is a director at Central Bank of Brazil, is making his presentation, and after him, Vinicius is going to talk about from a perspective of the payment sector. He's an executive director of Abipag.
Thank you so much for having me here. It's really a pleasure to participate in such a distinguished panel and to share ideas, to discuss insights with all of you. So I'll benefit from Professor Shelanski keynote remarks as they very much set the stage on anticipating many ideas about digital platforms regulations. So digital platforms, as described by the professor, they benefit from sizable network effects. They can be direct or indirect. That's what we call the feedback effects. Scope and also scale efficiencies, externalities associated with data, switching costs. There are a lot of incentives for one-stop shopping. So there are many departures from the, let's say, the neoclassical perfect competition benchmark, right? So it should come as no surprise that there's so much discussion on how to regulate these platforms. And one thing that's particularly relevant from the perspective of the Central Bank of Brazil is that often these platforms, they step into adjacent markets and they integrate the products from the adjacent markets into their own ecosystems. That, of course, generates value to consumers. This integration is worthy, but then the platform becomes, let's say, this new entry point, becomes the new gatekeeper. And in a sense, there is a competition to see who is on top of the stack, right? Who is the ultimate gatekeeper. So this is the case of payments. There are others, of course. And these new gatekeepers, they can in fact append the original industrial organization of this market and generate new distortions as these platforms try to monetize on the most effective way. So I would describe one recent example. Everything that I'm going to tell you is public information that was that was under the realm of the central bank. So that's in 2020 when Facebook announced WhatsApp Pay, which is, as the name says, it's a payment service within the app. So there are two types of transactions that could be done, that can be done. In fact, WhatsApp Pay is functioning very well. One is peer-to-peer transfers. So in this case, WhatsApp serves as a tokenizer. So a tokenizer is the entity that essentially creates an encrypted digital representation of the card. Okay, so nowadays we see more and more tokenizers. So WhatsApp was a tokenizer, as the card was stored in the app. And also it served as a payment initiator, as it would reach the issuers of the card and essentially tell the issuers to do the transfer, right? The latter, payment initiator, is a regulated activity. The other type of transactions is person to merchant, right? So it's commercial payments. In this case, WhatsApp would again serve as a tokenizer and also as a network service provider, essentially the last wire between the consumer and the acquirer, okay? That's not a regulated activity. So one, in a sense, a crucial aspect of this case is that the way that WhatsApp Pay functioned is that originally there would be only one acquirer serving the partnership. So the acquirer would be Cielo. So there was a lot of attention on that aspect. So in a sense, if especially the P2M alternative, if that was successful, were that to be successful and essentially obtain the large network effects that it had the potential to acquire, every merchant that would like to be in the WhatsApp marketplace would essentially have to hire Cielo, right? Which is quite distortive if you think of the acquiring market in general, because essentially people would leave other acquirers to be with Cielo, since you know, there is a one-stop shopping incentive to already benefit from Cielo at the WhatsApp Pay application. So there were also concerns back then about the use of WhatsApp Pay, of WhatsApp and Facebook on consumers' payment data. So of course, as a regulator, the central bank could only give the green light to this venture, provided the guarantees about privacy, banking secrecy laws, and privacy in general, that these guarantees were strong. So, recognizing these risks, and there was a lot of media on that at the time, the central bank determined that this new service could only go live once the modifications in the essentially the rule book of the payment scheme were approved. So that of course regards operational risks and also privacy concerns, but mostly competition concerns. And there are, in a sense, two concerns that were addressed with that injunction. So the first one was that WhatsApp could only operate if other acquirers would join the service. The last time I saw, I think there are 5 or 6 acquirers already serving WhatsApp Pay. The second, and that's in fact a change that we made perennial, which is that when a partnership or a modification of the payment scheme rulebook has the potential to affect competition in a lasting manner, it has to seek the approval of the central bank even before you get any threshold activity. There was also an issue about pricing. So WhatsApp, as always, would be free for consumers, but could levy a sizable fee on acquirers, right? And that's I mean, usually in two-sided markets, you know, since the original papers from Rocher and Tirole, we know that pricing that pricing is tilted towards the inelastic side of the market, and there is nothing inherently wrong with that, right? But in the case of stacked platforms like that, there is something to worry about, which is that the one side is inelastic, not because of primitives, because of consumer preferences, but one side is typically more inelastic because essentially you have a problem of multiple margins. You have double or triple marginalization, right? You have some markets that are concentrated, so the level of pass-through is limited. So it's essentially, it serves as a way to monetize without having any price signal to consumers. You're essentially taxing all other intermediaries. And of course, we all know that when you tax intermediaries like that, price discrimination, at least as a function of the payment method, is not something that is as widespread as one would look like. So typically, not only there is cost absorption, but there is mutualization of costs for all consumers, including those that are not using the service. So the pricing was also of concern, precisely for, let's say, rather than charging consumers who were essentially the ultimate users of the service, they were charging acquirers who would absorb costs in a way that are not the most efficient, right? So this case, I think it illustrates some key aspects that they apply more broadly to the regulation of digital markets, right? Digital platforms. One is that when these big players enter the market, they essentially start dominant, right? I mean, there is no wait and see, right? You have to think of solutions that are somewhat ex ante. The second thing is that the pricing is tilted towards the inelastic side, but the inelastic side precisely because of double or triple marginalization and cost absorption, and that magnifies inefficiencies, right? And the third is that, in a sense, the impact on the market structure of the ancillary market typically contrasts with welfare maximization. These platforms, they don't want the ancillary market to in a sense, to generate as much consumer surplus as possible. I think that there is a price incentive to have concentrated markets precisely because cost absorption is stronger. So in a sense, as Professor Shelanski mentioned, there are multiple routes through which competition enforcement can occur. One is that courts can adjudicate antitrust cases brought by public agencies. That's certainly one possibility. The other is that enforcement agencies with regulatory powers, they step in and they issue and enforce regulations. So the case that I was mentioning, the WhatsApp case, is a case of the latter. So the sectoral regulator, which is the central bank, had to step in. But to be fair, we had to use generic provisions. So we didn't have particularly well-suited provisions to the regulation of digital platforms. So it was a bit of, the whole thing was a bit improvised, right? So we're currently in the process of building this institutional framework. I believe that more broadly, Brazil is moving in the direction of having a digital regulator, probably CADE, which is, I think, is great news. And I think from the perspective of the central bank, we're looking forward for this initiative to advance, and especially on what pertains to the integration of sectoral regulation applied to digital platforms. That's something that the central bank is already working on, and let's say the more general approach that's going to be undertaken by the digital regulator itself, right? So I think there's a lot of work to be done, and I think the WhatsApp Pay case I was describing is a nice preview, in a sense. It already highlights certain issues that are constant in many applications, particularly to payments, and I believe to other ancillary goods as well. And yeah, so that's what I have for now. Thank you.
Thank you so much for the invitation. It's a pleasure to be in such a distinguished roundtable. I should start with Wittgenstein. Whereof one cannot speak, thereof one must be silent. He meant to deal with a philosophical problem, but in my case, it follows because I'm following the speeches by Professor and by Renato and by the two professors, so there isn't much to be added. That's the advantage of speaking last. but I'll repeat some of the stuff that has been said here. Most of what I'll be saying will be substitute to what's being discussed, but I'll add some complement discussion. Well, again, as Professor spoke in his presentation, network externalities generates a kind of a coordination problem, and as a consequence, switching costs. Feedback effects are prevalent in networks. So we provide data, the service becomes better because we provide data. We use more the service, we provide more data, and this gives advantage to those guys who are the platforms with custody of those data. And these guys are big and have deep pockets to implement subsidies. And there's work by my friend Laura Veldkamp saying that, you know, this data-driven type of interactions leads to unexpected ways in which economics show up. So looking at, you know, markups per se might not be fully informative. These platforms, they get data for free, for instance. They don't have to pay for the data. They face less risk in extending credit, for instance. So the antitrust and competitive challenge isn't trivial. So there are particularities of those markets and the way the whole service is provided that matters. From my perspective, I think that Brazil is still ill-equipped to deal with big platforms. I guess we don't have the regulatory pathways. I guess this is an expression I'm borrowing from Professor Shelanski. And I recollect in the WhatsApp Pay case that the central bank had really a hard time trying to find the frame in which the intervention should be done. So I guess they had to dig deep in their official and technical mandate to intervene in that case. And it was fantastic that they did. So a standard exposed type of antitrust approach would have caused a lot of harm, as Renato suggests. I'm happy as well that the government has just released the outcome of a public consultation procedure that meant to tackle the problems of economic regulation of platforms. So it seems from what's being released that the guidelines are correct. So we'll be, you know, selecting a handful of gatekeepers and imposing on them sort of ex-ante regulation, mainly guarantee of access and interoperability types of restrictions. CADE will be the agency in charge of such oversight. I think that's great news. Is the agency really, you know, able to do so, and with the help of technical agencies, because as far as I can tell, economists and lawyers are still not kind of equipped to deal with APIs and such. So in Brazil, I think that there are local and, you know, specific players that bring some concern for an association like Abipag. So mainly commercial and delivery platforms, much because of what Renato said, because it's natural that adjacent markets like credit and payments will be attacked by those platforms. But one thing that I want to bring, and I guess it's complementary to what's being said rather than a substitute, is that policy can have a very important role. I want to give two examples, PIX and the Open Finance initiative. So PIX is revolutionary. I wonder what would have happened to PIX if WhatsApp Pay was not, you know, subject to the scrutiny and oversight that Renato just described. PIX is a real neutral and open platform. And it's really great what PIX has done to citizens in Brazil. The Open Finance regulations really also spectacular. I want to point out that it stems from an antitrust case in which CADE was critical, the Guia-Bolso case. So after the Guia-Bolso case, not only there was an antitrust quasi-intervention, but also this led to the regulation of open finance. And the regulation is pretty good because it's not only about setting rules, it's also about building pipes and guaranteeing procedures and standards. I always recollect that my friend Arminio Fraga, back in 2002, released a regulation in which the sharing of registry data was mandatory. But without the pipes, without the infrastructure, that did not pick up, of course. So really, really important that you set standards and you build the pipes, you build the infrastructure. One question that I have in Brazil regarding data is, and the importance of data in this markets, is why can't we enlarge the scope of the open finance and move towards an open data type of environment? So why not platforms sharing data? Sharing data, consumers of platforms sharing data, because the data is consumers, not the platforms. So I think that we should advance in this direction. I want to finish with something that's not really economical. I believe that democratic values are above competition values. So I'm really concerned that although we're moving forward towards a DMA type of regulation, we're lacking a DSA type of regulation. Probably that's not, here's not the best place to talk about it, but kind of concerns me. In Brazil, when the legal framework, the Marco Civil da Internet, was launched, we had the assumption that platforms were neutral. They were only pipes. We learned in the hard way that algorithms are de facto serving as an editorial procedure, editorial device. We're learning more recently that beyond that, beyond the algorithms in these platforms, we have controllers posting and supporting candidates and supporting policies, and all this without any of the liabilities that news outlets have. So I really think that, you know, these guys should have liabilities similar to those that news outlets have. And maybe we should combine those liabilities with sort of an open finance type of regulation. So Francis Fukuyama, I guess, was the guy who made the biggest mistake ever in the social sciences. So he declared in the 90s that the history was over, the end of history. He proclaimed the end of history. We're learning the hard way that history is alive. But he proposes that somehow we should have open APIs, allowing for sort of an ISP for news. So news aggregators playing an editorial role, and some regulation moving economics from the platforms to these guys so they can survive. So maybe we should try to combine the open data with a view that there's a way to make sure that the social media and platforms can really be source of information, not misinformation. Thank you so much.
Thank you, Vinicius, and thank you also, Renato, for the presentation. We are going move it forward to Márcio, which is going to give us a little bit of Brazilian cases. Okay, thank you.
Okay, thank you. Thank you, Camila. Well, thank you for having me here. It's a real pleasure to be sharing this table with these panelists. And maybe to wrap up what has been said, I think starting with Professor Shelanski's paper and lecture, I think the parallel that he draws between, you know, the telecommunication sector and the current debate about how you regulate, or at least, you know, you oversee digital markets. I think it was a very interesting one. And I think we could also do that here in Brazil because we saw a big change or a big reform in the telecommunication sector. There's a lot of cases between before the telecommunication agency and CADE over the years. But I would say that the financial sector experience may be even richer in a way. For the last 15 years, I think we have seen in Brazil a tremendous change in the not only in payments specifically, but also in the financial sector more broadly, a sector that used to be very concentrated in a way. It still is, but certainly much less concentrated than it used to be. 15 years ago or so, and when we look at the history there, I think there is a lot of lessons learned that could be used for the current debate that we have here. Starting with this interaction between the two agencies, I think it has been quite important to have that dialogue and see how CADE and the central bank have been working side by side and having a lot of discussions and debate, of course, sometimes looking at different things and paying more attention to different values, but in a sense, at least from my perspective, I think we have seen more cooperation and conversion, if you will, than contradiction, and also on cases. If you look at the history of a lot of cases, starting specifically with cases related to the financial sector, and then starting more recently into pure platforms. We also see that what Professor Shelanski said in his paper about the pros and cons of each types of remedies there, and this and divestitures and line of business restrictions being more problematic than remedies on access, interoperability, and interconnection. I think we also see that in the evolution of the payment sector and the financial sector in Brazil, when we look at CADE cases. If we go back to 2010, when CADE looked at it started with the Visa and VisaNet case, where there was this restriction on exclusivity there, or the ban on exclusivity. Then right after that, we had the Banco do Brasil Nova Caixa case, where there was a concern about access to information and how that could be used by Banco do Brasil to leverage its position, and then CADE imposed a remedy in that case, which obliged Banco do Brasil to give access to customer information and allowed customers to have more visibility, and also at least more to facilitate in a way the switching to other banks, and you continue to that. Marcos mentioned IE-UFRJ. IE-UFRJ was, I think there was a lot of discussion and a lot of concerns, almost related to a quasi killer acquisition type of thing. But on the other way, there was also a concern about how that transaction could give or enhance XP's position in its own market, or in a market in which they were more focused on, which was the investments products and the distribution of investment products. And there you had a series of remedies or commitments being required that were including some commitments to allow for or facilitate portability and allow customers to also switch to other investment platforms who were being created at that time. Another case, Vinicius mentioned the Guia Bolso case. There was also this type of concerns there when we had remedies imposed by CADE forcing Bradesco to give access to or develop APIs and give access to information. And then more recently, we saw there was also a reference here to delivery platforms. We see in the iFood case, one of the commitments there was a commitment to keep the APIs, certain APIs open to facilitate also restaurants to do business with other platforms, delivery platforms. So in a way, I think that the experience here in Brazil also show, and when we look specifically to the financial sector, that you can do this almost, it's not really exposed regulation, because some of those cases were initiated and ruled as the platforms were being created, developed, and also changing their models in a way. But I think this shows that, I mean, the proposition that Professor Shelanski made have also been used in a way here in Brazil, and in my view in a successful way so far. So I think we have some good examples here that can help us, looking ahead and continue this debate specifically when it comes to digital platforms. Those are my remarks here.
Thank you, Márcio. I don't know if Professor Shelanski, do you want to do a couple of comments?
Yeah, I could just make a couple of very brief comments. These were all excellent and really informative presentations, and I think a couple of themes come out of them. I mean, one thing that's clear is just the context dependency of exactly how any particular remedy will play out in a particular industrial context. Very different kind of thing when we're talking about financial services and fintech, but we see some of the same principles, when it comes to, being agnostic as to different acquiring banks. And, I think there's some very interesting questions about access to tokens and different providers of tokenization going forward, and as we move forward with some of the interesting card service changes that are going on. I think another point that we learned is you can never, these solutions may well be worthwhile, but they're not easy. We shouldn't think at the end of the day that you can avoid some serious technical analysis and know-how. And that is going to be, there is no costless regulation, and there is no regulation that is in some sense easy as we get into these technologies. And in some sense, if you think about a judicial remedy, at the end of an enforcement action, an ex post enforcement action, that's a very tough thing for a judge, because a judge does not want to keep and oversee the implementation of a remedy forever. There are cases where that's happened, but that's a difficult thing. So you really need an agency and a process for coming to agreement on what the right technical sort of protocols and are. And I think that's going to be that's going to be difficult. I think the point I would make, though, is the gains are potentially enormous when you think about the scope of the direct and indirect network effects that are at issue, and the openness that could be created to innovation, which takes me a bit to sort of Marco's point. There is a real benefit to having these multiple pipelines, and sometimes these pipelines are actually very proximate in the kinds of solutions that, or the kinds of problems they're trying to address, to the pipelines of the incumbents. And you talked about acquisitions and so-called killer acquisitions or nascent competitor acquisitions, related but not identical class. That's not a remedy that I talked about. I think there are a lot of challenges there, but I do think that is, of course, another remedy that has to be thought about. But we do need this richer and better concept of how to define an innovation market. The capabilities approach is one very promising way to go, and we're going to have to think about what kind of error costs we are willing to tolerate in terms of, protecting the innovator and that innovation path from being absorbed. And I think that's another, a very, very tricky kind of question that's going to emerge. I think the important thing to recognize is all of these solutions, I think, are driving at the same thing, which is to allow these innovators to have a path that they really can come and move some of these markets and technologies forward.
Thank you. I'll now leave open for questions. Mario was in the line.
Thank you, Camila. Thank you, the speakers. Thank you, Professor Shelanski, for the great presentation as well. Just very quick comments or very quick points here. One, to Professor Shelanski's keynote speech. One question here, Professor Shelanski, is the question of intrasystem and intersystems competitions, right? If I fully understand your point on access and interoperability as diminishing barriers to entry, reducing shifting costs, and allowing entrants to tap on the externalities that are available, right? So that's the reason behind these. In some circumstances, though, competition in between systems, non-interoperable systems, may be the path for innovation. We think of different paths that innovation can go. So one of the questions is how to distinguish those, right? How do we choose whether to move on to interoperability or to actually allow for other systems to actually develop and try to compete? Like arguably maybe TikTok did that in social media, right? So I think that's one point. And the other point, just on the discussion on financial markets, is I think in Brazil what we had, which I think is quite interesting as a virtuous circle, is that CADE made and addressed many cases, as Márcio described, and identified potential bottlenecks in these markets, right? So exclusivity, the necessity for interoperability in the acquiring side, discussions on ping pads, discussions on the receivables, so on and so forth. And then the central bank regulated those bottlenecks. So what we had is antitrust pointing the directions of some concerns, and then regulators coming in with broader regulatory measures. And I think we saw that very intensely in the beginning of this process in 2013 and so on. And I think that's quite interesting to look at in other markets where we could have the same dynamics of antitrust looking at where are the bottlenecks, and then regulators coming in with broader solutions and remedies. Thank you.
Really wonderful points, Caio. Thank you very much. Let me just start on intersystems. So intersystems to me is fantastic and should never be barred, right? I mean, I don't think we should ever say we're going to do interoperability, so we're not going to allow intersystems. I don't take that to mean, to be your suggestion, but in some sense, intersystems is the ideal because it suggests that the bottlenecks and the network effects that exist on one system may have an alternative. To me, the hard question for regulators is when there is potential intersystem competition, how certain do they feel they need to be before they say, we don't need the interoperability on that system because there is the alternative? And I think the history shows that intersystem is often one of the best solutions. For the longest time, we saw a very burdensome and complex set of access and unbundling rules on incumbent telecommunication carriers in the United States because regulators kept believing that landline telephone service was still the system they needed to regulate when people were abandoning it in droves and pretty soon it was like, why are you regulating that? We all do wireless. And then they realized, okay, let's get rid of all those rules because there was inter-systems competition and all we needed was, the different systems to exchange traffic. So to me, the hard question is when there is an alternative system that is to some degree nascent, what kind of predictions and what kind of certainty is needed for regulators to say, that's enough that we don't need the interoperability? I do think that there is a risk with interoperability, which is that you might, by giving people easy use of incumbent resources, free them from doing the investment in the development of the alternative system. And so I always think, to the extent that there is a credible intersystems competitor, even on the horizon, you need to craft your remedy so that as that grows, or as that becomes more plausible, you're not locking people into one of the systems because you've given them a regulatory free ride. So two things are very important in any access, interconnection, or interoperability remedy. Not making the pricing so punitive on the incumbent and so, in some sense, too low on the new entrant, such that they don't invest in the alternative system. And second is having a revisiting horizon where you come back and say, you know, are we locking in? But you've identified a really key point.
So my question is for Marcos, mostly. I really find the capabilities approach compelling, but I wonder if you see a tension, like I do, between innovation competition and innovation. And what I mean is, in a merger, I can easily see a situation in which there is a reduction for innovation, a pipeline for a certain product, because the merged entities, say, are both investigating paracetamol or something like that. However, at the same time, an increase in the capabilities to innovate, right? So my question is, are you aware of, or have you been thinking about a theoretical framework to resolve that potential tension?
Thank you, Lazar, for your question. To be fair, we just launched a paper on that last month, which is part of my PhD thesis, which was advised by Camila here. And the framework we propose, it understands innovation competition as occurring in 3 layers, actually, which we call the 3 phases of innovation competition. And one of them is pipeline competition. And when we have competing pipelines, we need to check whether innovation incentives will be diminished, and there may be a delay or interruption of that specific innovation effort. But on the other hand, we have to look at those capabilities. So there are separate evaluations, and whenever, let's say, there's less incentive to finish that pipeline, but capabilities are going to be greater, you have to design a remedy that prevents this. You can, as an example, divest that pipeline to another competitor, so we can actually enjoy the increasing capabilities while maintaining the incentives to finish that pipeline. So that's an example. But we need to look at all those dimensions of competition simultaneously to design the better solution for that case.
Thank you, Camila. Thank you for this nice chair. I have a burning question. Just trying to wrap it up a little bit. So do you think, for all of you, if you could extend the example that Professor Shelanski gave us about the telecom sector in the US by saying that, for example, every time I come home, I see some fine discussion about the energy sector. So in the energy sector in my state, what I learned last time, there was a big industrial that managed not to pay taxes on energy production or energy sector because he made a huge investment in solar panels. So he was not in the system anymore. And the local court actually gave him this right of not paying taxes because he was not actually using the network. But in the minds of the regulators, everyone, even if you're not if you're using or making investment in solar panel, you have to pay because you need to pay for those that actually invested in the electricity generation transmission network. So my generalization, as we're seeing with the digital markets, is that yes, for us at a moment of time, because we do have these big industrials, oligopolies that made the largest of the cost investment in infrastructure, and then you need some regulation at the beginning, until you have a kind of newcomer or new technology that will disrupt the market, and then we don't need this regulation anymore. So just to wrap up, do you think we can actually learn from what happened in the past with the other technologies, that we can actually have some flexibility in terms of, yes, we need regulation at some point, but then when you have whatever new technology kind of disrupting the whatever sector we're talking about, then we can also flexibilize these regulations. Thank you.
Want to go first?
Thank you. I mean, again, this is the regular conundrum of dynamic regulation, and I think that in the energy sector, what's very interesting about it is, it comes out of having to compensate the original builder of the grid, right, of the transmission grid. And I think at some point you have to say they've been sufficiently compensated. People who are moving to different technologies don't have to participate in this regulatory subsidy scheme. In the US, it was a big problem because we subsidized local telephone service. And when the wireless carriers came in and people started abandoning the sources of subsidy, the incumbent networks, the long distance, wireline service, they tried to make the wireless service providers pay into this fund. It was exactly what you've just described. And there comes a point when you have to say that regulation that is driving that taxation has to stop because, technology has moved on. But I think as a general matter, the problem you raise is going to be an important one for any of the kind of remedies that we're talking about. Because at some point you have to tell the beneficiaries of the regulation, time for you to go off on your own, and time for us to leave the underlying original incumbent free to compete. And so the question of how long regulation should last and under what conditions it should be repealed, I think is one that exists in all of these situations, especially where you're requiring an incumbent to make its resources available. The one thing I would say is I do not think that is a reason not to regulate. I think it's a reason to regulate carefully and to think ahead to that dynamic problem. But again, when we're talking about the size of the consumer benefits and the technological benefits that could be unlocked here, it seems like a risk worth running. And it may get messy in a few years, and they may have to repeal the regulation, but that doesn't mean it doesn't achieve some benefits on the way.
Does anyone want to add? Any other question? Good.
Question for Professor Shelanski. Going back to your presentation, you mentioned that there are some parts of the DMA that you like. I take that to be, and correct me if I'm wrong, data portability, interoperability. And you also mentioned that there are some which you don't like. I would like to ask you which ones those are.
So I have reservations about two things in the DMA, and I think it's a much longer discussion. First of all, I think the thresholds for designation fail to capture a lot of submarkets in which you can have certain kinds of dominance. So I think that I really question the equivalence of market cap with dominance. I have some concerns about that mechanism. I understand the rough justice that was necessary for the original designations, but I wonder how much the system of designations really gets at underlying competitive problems. And the other thing I just don't love are the things that border on barriers to self-preferencing, which are effectively line of business restrictions. And again, we'll have to see how those are actually implemented over time, but there are huge benefits to coordination, internal, short of discrimination. Do you actually prevent people from doing certain kinds of coordination, organic movement into adjacent markets? I have real concerns about those, and I think that is something that could emerge from the DMA. But again, it's early days. It's not quite the French Revolution, but it's early days.
Thank you. I want to do a question, if it's possible. We've been talking about innovation, and somehow what we are doing here is to recognize that innovation it may be very different depending on the sector. And even within a sector, maybe they may be different according to different services that are that we are looking for. So I would ask maybe for Marcos or Professor Shelanski, do you think that a principle of flexibility in regulation, digital, would fit this vision and would be more appropriate when we are talking about the obligations, and do you think that should be under a gatekeeper flexibility or under services?
Okay, thank you, Commissioner. That is a challenging question. I do think that here is my concern about a service by service regulatory approach, and I want to make, if I haven't understood the question well, let me know. I think that proceeding at the level of gatekeepers is, in the first instance, especially in the digital world, very important. Sure, it is possible that the same gatekeeper that is a gatekeeper, for example, in search advertising or something like that, is not a gatekeeper in something else that happens on its platform. But I do think we're in a world where the same inputs are frequently used across the multiple services that exist on these platforms. So if you go back really to the level of things that are generic inputs, electric power, data of different kinds that may drive very different kinds of services. Even when we're talking about sort of artificial intelligence kinds of applications and bringing that increasingly into these digital services, the availability to have a very diverse range of high quality training data. So, data that may go well outside the service that is the gate-kept service, but be used to train the algorithms that have multiple uses. So this is going to be one of the very challenging things as we move into regulation in the digital era. You're going to have these platforms that are, let's take Google. They were a failure in social media. Let's take Facebook. They were a failure in photos. And yet they had this underlying kind of technology that was sort of deployable across all of them. And I think if you start to go down to the level of service regulation, that could lead you astray and miss some very important things. So my general sense is I would identify the gatekeeper and I would regulate the underlying inputs, even if that enables some entrants or emerging firms in lines of business other than the one that has been monopolized.
I believe that very much in line with Professor Shelanski, what he said. Regulations is only going to work if it's flexible and asymmetric, because platforms are different, and not only they are different, but we are going to learn through time. Regulators are going to learn as time goes by. So we can have to the same gatekeeper asymmetrical obligations depending on the service, because they have like different market power between the services, but they need to be they need to consider the different how can I say, the different aspects is going to take in through time, so it's going to change. So these markets are very dynamic. A gatekeeper may be a dominant platform in a service, and maybe not, it's not going to be in the future. So we need some asymmetry and some flexibility in order to be able to fully protect the market. So there must be some flexibility, and of course regulators are going to learn through time. So we need to be less worried about how well we know how to do it, start doing it and learn as time goes by.
Is that, oh, okay.
Sorry, this is loud. Thank you. I just had a question. So from the conversation, especially from a few panelists, I felt that there was quite a bit of skepticism about the divestiture solution as opposed to interoperability, access to data. And so I'm just wanting to ask a very blunt question, that what's proposed in the United States around search, whether you disagree with that proposal to divest Chrome. And then maybe just a question secondly about the AI stack. We haven't talked about that specifically, but I know this is a panel about the digital world. And so one of my interpretations of the AI stack, and especially generative AI, is that yes, of course there's value in the data, but there's much more value in the infrastructure for computing, for developing the models, processing the data. Because if you see where the current money is made, it's by the duopoly I call OpenVidya, so OpenAI and NVIDIA. So really, from just looking into the future and where competition should focus, I think simple access to data provisions won't really help us deconcentrate this market, but I think we should look really carefully at the infrastructure, because while it's generative AI today, it may be a different technology tomorrow, but what we always need is computing infrastructure. So just some thinking whether you think that assessment is correct, and if that is correct, what competition, what lens, what remedies we should start thinking about in what we all acknowledge is complexity on steroids, I guess, when it comes to the AI stack. Thank you.
Thank you, Vera. So yeah, I haven't talked in a lot of depth about AI, and I should disclose I provide some legal advice to a major standalone AI company. So I might stay away from some of the AI specific issues, but let me just address briefly. First, your question about divestiture, then I'll come back to AI and infrastructure. There are divestitures that can work. I think they have to be very clean and standalone. And by that I mean the thing that is divested has to be able to operate without lots of transition services agreement and remaining interrelationships with the company from which it is carved out. If it is dependent on that company for infrastructure, for technology, for data, you have to have a whole lot of regulations in addition to the divestiture to preserve that clean break. But if Chrome can be technologically carved out and forked as code to a standalone entity that can operate it without continued entanglements with Google, there's no reason it couldn't work. I haven't done enough analysis of that particular remedy to know how helpful it will be in solving some of the problems. But I don't necessarily say that it's a bad remedy. I just would have to know more about what it would achieve, and I'd have to be convinced it was sufficiently standalone. When you talk about AI or maybe some future of quantum computing or something like that, you're absolutely right that infrastructure is a massive problem. Infrastructure is a little different from data, though, in a couple of ways. The infrastructure, it may be that the large incumbent platforms have a lot of their own compute. They have a lot of their own infrastructure. Google produces some, compute. A big buyer like Microsoft can obtain an enormous amount and is obviously developing some. So they may have advantages, but there are third-party producers of compute. Obviously, NVIDIA. NVIDIA is, the most important provider of GPUs for AI, and they are not, otherwise engaged in these other lines of business. They're providing a critical input. So I think the case for regulating the so-called big tech platforms for access to their compute is weaker where there is a third-party provider of compute. And instead what you probably want to do is say, they can't have exclusive dealing arrangements or overly large requirements contracts or something like that with the third-party suppliers that effectively foreclose the access that a standalone AI company would have to the necessary infrastructure. So it is a little different in that regard, whereas the data that is needed for training is actually generated by the user, not exclusively, but in large part by the user bases of these incumbent networks, and that's not something you can get from a third party. Now, obviously there is synthetic data, and it's getting better all the time. But we are not at the point yet where these generative AI models can generate their own training data. And there are obviously some problems, and eventually you do have to have external data to quality control and to fully train some of these. So I think data and infrastructure, you're absolutely right, infrastructure is critical. We're gonna have to look very carefully at the arrangements there to make sure that newcomers aren't foreclosed from getting it. We need more capacity and we need more companies building compute. But it seems to me a somewhat different problem from the data problem.
Thank you. So I think we can end the panel. So I would like to thank all the speakers and the audience and say that it's going to have a coffee break just in this floor, in the same floor, not downstairs. And because the organizers asked me to, I also wanted to say that it's a great pleasure to be here, not as an organizing this year. So it feels really good. And also, as a visitor in Rio, I just felt this is really good to be a visitor in Rio. Okay, thank you very much.